Welcome to Montage Services video presentations. And what we're going to do today is talk through international tax concepts, the very, very basics. We have three videos in this series. International 1, which is what we're talking about today, International 2, International 3, and then something on foreign tax credits. So the topic is about U.S. taxation as it relates to companies that are inbound, that is investing in the United States, or outbound U.S. companies that are investing outside the United States. Montage Services is a professional service organization that is worldwide. We have offices in San Francisco, Houston, London, Toronto, and Berlin. And this is the area that we feel that we excel in, which is international tax. So these slides are a variety of topics. We're just touching on them, but it's to give you a flavor of some of the considerations as it relates to U.S. tax matters. So first is inbound versus outbound. When we look to inbound taxation, we're generally talking about U.S. tax that is being earned by foreign individuals or foreign corporations, those people who are not subject to our normal U.S. tax rules because they're residents or citizens of other countries or they're domiciled in another country. Outbound taxation is a U.S.-based company that is then doing business abroad. And that's a separate area of taxation, actually, even in the tax code itself. So when we look to the taxation of foreign corporations that are invested into the United States, there's this topic or word phrase that comes up, effectively connected to a U.S. trade or business. So most businesses investing in the United States do so by sending a few people over to a particular state or city, and those people then try to transact business on behalf of the parent organization. Those people are in general creating a permanent establishment which then has income that is effectively connected to a trade or business in the United States. That income would then be subject to the U.S. tax system. There's also cases where a foreign taxpayer might receive fixed determinable annual or periodic income. What kind of income is this? It's your interest, dividends, royalties, annuity type of income, which is regular and fixed. That would be more subject to a withholding tax, but is also where the United States taxes foreigners on their transactions in the United States. We've touched on in another video the incorporation process of a U.S. company in the United States. It's important to know that if a foreign business is doing business in the United States, that they consider the different types of organizations that they might use to do that business, and if they do set up a subsidiary, it sort of blocks the foreign company from lawsuits that might happen within the United States. It also provides a defined area as to what is the transfer pricing as well as the taxation of their business in the U.S. That business will also have to register to do business in the city and potentially county where they're located. So if they have people or employees, they're going to need to register with the local as well as the federal government. And there are sales tax implications in the United States to selling goods and services in the United States. Unfortunately, that's on the county level, and the counties are numerous, and therefore it's well advised to understand those sales tax implications as you begin selling into the United States. Unique to the United States is on the unfortunate thing that we tax organizations on a worldwide basis. So individuals who are either citizens or residents, i.e. green card holders, have to pay tax on a worldwide basis. Also, U.S. companies have to pay tax on a worldwide basis, which is to say that if a foreign company sets up a U.S. company, and then that U.S. company has other subsidiaries, say in Mexico or Canada, it's going to pay tax on all of the income that's earned in the U.S. Foreign tax credits are generally available to offset the double tax nature of that system, taxing on a worldwide basis. So a foreign tax credit is available, and again, we have another video on foreign tax credits. So we touched on this concept of permanent establishment. What is a permanent establishment? It's actually defined by the OECD Model Treaty, and that is a worldwide organization that tries to build consistency in taxation around the world. A permanent establishment is a fixed place of business, an employee that's contracting on behalf of an organization, and there are certain exceptions. But in general, if you're conducting business in the United States, that means you have a permanent establishment in the United States. The most common question we get is, well, let's say we're selling something on the web. Is that a permanent establishment? And the answer to that is, currently, it is not. However, they've gone so far as to say if your server is located in the U.S., that could potentially be a permanent establishment. The exceptions are in the actual tax code regulations, a warehouse. So if a warehouse is being used in the United States, that will not create a permanent establishment, as well as an important exception is a bank account. So if a foreign company sets up a bank account with a U.S. bank, then that's not going to create a taxable presence for that foreign company or even the non-resident individual in the United States. So, should a foreign organization set up use a branch or a subsidiary? It really looks to what is the business trying to accomplish. We would suggest that tax shouldn't play into this question. To us, it's a matter of what is the business, what is the marketing associated with that business, and what is the impact of having a subsidiary? Is that a beneficial thing or is it detrimental? Where are they most likely going to have people and property in the U.S.? What is the sales cycle as well as the supply chain associated with the business? Those are all questions that would affect whether or not to use a branch or a subsidiary. The other thing may be that the home country has a treaty with the United States. If that has a tax treaty, how does that impact the branch versus a subsidiary question? And for those who don't know what a branch is, it's just operating in a country without having a legal form, without having set up a company. So that is viewed as a branch. Oftentimes we like to put in place a blocker company, which is setting up a company, U.S. company, because if you don't, if you go by a branch form, then the foreigner, whether it be the foreign company or the foreign individual, needs to file a U.S. tax return. Dealing with the U.S. government has its benefits and detriments, and if someone does not want to have to file with the U.S. government, using a blocker company can be useful. We're not going to touch upon the outbound planning in this particular video. We have another one which will talk through the outbound tax planning services. But again, consider the area itself. It's dealing with trying to defer U.S. taxation, which we said is on a worldwide basis, keeping profits offshore so it's not taxed currently into the U.S. If you have questions on any of this material, feel free to reach out to us and we will get back to you and respond to any questions that you might have. Does our group have any questions? Yes.
If I form a branch, is it the same tax rate as a corporation?
Yes, a branch will be taxed at the same rate as a normal C corporation. And they have what's known as the branch profits tax, which is the equivalent of a withholding tax on interest and dividends paid back to the home country parent organization, home parent company. So there is an equivalence, but some tax people feel that knowing all the inputs that go in with a C corporation or a separate subsidiary is a much better way to plan than having a branch. All right, thank you.